Welcome to The Weekly Option, the podcast for people interested in trading stock options. Each week, we cover trade ideas and opportunities in the stock market right now. Whether you're a beginner, a professional, or just curious about options, this is the show for you. Let's get started. Welcome to The Weekly Option. This is episode 293 on October the 21st, 2023. I'm your host, Eric, and in this week's show, we'll cover the trades from last week on Tupperware, AMC Entertainment Holdings, and British Petroleum BP. And we discuss three new trades on Snap Inc., Delta Airlines, and the Proshares Ultrashort 20-year Treasury ETF. Now, it's always great to hear from listeners. If you have any questions about the trades presented here on the show or even about your own positions, feel free to email me. You can email questions to eric@theweeklyoption.com. That's ERIC@theweeklyoption.com. I've also created a few videos to teach you all the basics of option trading that you'll need to know to be able to follow along with me on this show. You can visit our website and click on the videos tab to watch them, or visit the YouTube channel for The Weekly Option. And for anyone that wants to learn how to trade options or simply get better at how they're already trading, we've launched the Weekly Option membership group. This group features video training that can be accessed online when it works best for your schedule, daily interaction with me and others in the group through a chat group, and ongoing videos and webinars to make sure everyone is up to speed and gets exactly what the help they need. Now, this is a community of option traders that can support you in your own growth. So email me immediately if you want to learn more about becoming part of this exclusive group. The U.S. equity markets tipped lower this week. The Dow Jones Industrial Average lost 543 points, closing at 33,127 points on Friday. The S&P 500 index lost 103 points, ending the week at 4,224 points. And now it's time for the topic of the week. The topic of the week is modeling versus copying. And one of the best ways to learn a new skill is to learn from someone else who's already doing it. One of the things that's popular in trading, specifically in trading communities online, is finding someone who you can copy. Several guys have live trading rooms which allow you to copy the trades of the main professional trader. I have several friends who have lost money doing this because they did not have the capital to manage the trade in the same fashion that the professional trader managed the risk. Oftentimes, the professional trader was able to take bigger losses than the individual was able to make, forcing the individual to close the trade at a loss, even when the professional trader ultimately was able to hold a position and make money. And to be honest, even when it works, you're simply supporting the trade that the professional already executed. That's why I lean more towards modeling as a better form of education than copying. If you simply copy a trade, you might not learn the reason for making the trade. Copying simply means doing the same thing they did because they did it. Modeling means using their logic or style to create a trade like what they would typically do. One of my goals for this show is to allow people to model trades. The trades I mention on the show are not truly executable because the prices change as soon as the market opens on Monday morning. That is done intentionally so that the listeners can model the style rather than copy the trades. Copying gives the man a fish and feeds him for the day. Modeling teaches a man to fish for life. If you ever wish to work with me or join the chat group, just know that I will push you towards modeling my trading style, not simply copying my trades. That's how the best traders I know were taught. That's the strategy that will likely be the best for your growth. All right, so let's get into the trade review from last week's trades. And spoiler alert, when you are long a covered call, when you are long a call spread and short a put spread, and the market goes lower, you're most likely going to lose some money. So we're going to start off with our covered call on Tupperware, symbol T as in Tango, U as in Uniform, P as in Papa. At the time, the stock was trading for $2.21 per share. I looked at buying that stock and selling the November 2.5 call at 30 cents, which could give us a return of 26.7% in 5 weeks. Now, shares of Tupperware fell 48 cents, ending the week at $1.73 per share. The call option we sold lost 15 cents, leaving us with a net loss of 33 cents on the week if we were to close the trade out immediately. The share price is below our break-even point, which would justify closing the trade for a loss or simply adjusting it. I'm looking at this one a little bit differently. The trade still has 4 weeks until expiration, so time is still on our side. Second, if we rolled the strike lower, we wouldn't collect much, if any, additional premium on the next strike lower. So I'm going to be patient on this trade and see how the stock reacts in the coming weeks. Remember, the main risk of a covered call is on the share price, meaning the stock, not the option itself. The option is covered by the stock, not the other way around. The stock didn't require much capital, so the loss is limited, and we can still look to sell more options against the shares in the future, even if we lost on this November trade. Now, the covered call strategy can give you a longer time horizon on the trade if you want, meaning you could extend this beyond just the month of November. So it's always important to look at all of your options on how to manage these trades. And of course, it depends on your personality and how you personally like to manage risk. All right, next up, we have the credit spread on AMC Entertainment Holdings, symbol A as in Alpha, M as in Mike, C as in Charlie. At the time, the stock was trading for $9.49 per share. I looked at selling the November 9/8 put spread at 41 cents, which could give us a maximum possible loss of 59 cents per spread. Well, shares of AMC declined 41 cents, ending the week at $9.08 per share. The out-of-the-money put spread we sold is still slightly out of the money, but the stock is lower and just a few cents away from becoming at the money or even in the money. Now, we are still above our break-even point on this trade, so we don't have to make an adjustment just yet. Still, it's definitely worth having a plan for how you'll defend this trade should it really move away from us in the coming weeks. So one way to defend this trade is to turn it into an iron condor by selling a call spread against it. Now, you could sell the November 11-12 call spread at 15 cents, leading to a total amount of 56 cents of premium collected for the overall trade. That will lower the break-even point and create a little additional cushion for the trade. The good thing is that we're still well above the break-even point for the original trade. So I would keep an eye out for that and decide in advance when you'll want to execute an adjustment or if one is needed at all. Even though the stock price went against us a bit last week, this trade was still expired fully out of the money at this point. So that's a positive. Let's see what happens this upcoming week. And then our final trade on the week was a debit spread on BP, British Petroleum, symbol B as in Bravo, P as in Papa. At the time, the stock was trading for $40.02 per share. I looked at buying the November 39.40 call spread for 65 cents, which could give us a maximum gain of 35 cents, or that's a 53.85% return in 5 weeks. Shares of BP fell 40 cents, closing at $39.62 on Friday. The in-the-money call spread that we bought is still in the money, but less so. It had an intrinsic value of $1 when we purchased it, and now it only has 62 cents of intrinsic value. That means this trade too is a loss on the week. Now we are 3 cents below the break-even point, justifying an adjustment if you were so inspired. Now with 4 weeks left until expiration, I'll still lean towards being patient and waiting for another week of price movement before deciding to adjust or not. Now, if the trade moves out of the money, I might decide to turn it into a credit spread. Or I could look to sell an iron condor against the long spread to take in some more premium to offset a loss. So there's a lot of time in these trades, so you don't have to rush to make an adjustment. Just have a plan ready for each of these trades in case the market does continue to slide lower. That's it for the trade review. I wanted to point out that yesterday, Friday, October the 20th, was options expiration for all monthly options in October. The new trades for the next few shows will use the November 17th expiration date for monthly options in November. Now, let's go ahead and get into the new trades for this week. We're going to start off with a covered call on Snap Inc., symbol S as in Sierra, N as in November, A as in Alpha, P as in Papa. The stock ended the week at $9.44 per share. I'm looking at buying stock and selling the November 10 call at 89 cents, which could give us a return of 15.36% in 4 weeks. Now you enter this trade by buying stock for $9.44 and selling the November 10 call at 89 cents. This trade makes the most money if stock prices finish above $10 per share. The break-even price is $8.55, and in real terms, the stock purchase will require $944, and you'll collect $89 just for selling the option. Next up, we have a credit spread on Delta Airlines Inc., symbol D as in Delta, A as in Alpha, L as in Lima. The stock ended the week at $32.22 per share. I'm looking at selling the November 33-34 call spread at 34 cents, which could give us a maximum possible loss of 66 cents per spread. Now you enter this trade by selling the November 33 call at $1 and concurrently buying the November 34 call for 66 cents. This is a credit spread because we are selling the spread, and this trade makes the most money if stock prices expire at or below $33 per share. The break-even price is $33.34, and in real terms, you would receive $34 per spread that you sell and have $66 at risk. And then our final trade on the week is going to be a debit spread, looking at the Ultrashort 20-year Treasury ETF, symbol T as in Tango, B as in Bravo, T as in Tango. And the stock ended the week at $44.10 per share. I'm looking at buying the November 43-44 call spread for 56 cents. That could give us a maximum gain of 44 cents, or that would be a 78.57% return in 4 weeks. Now you enter this trade by buying the November 43 call for $2.85 and concurrently selling the November 44 call at $2.29. This is a debit spread because we are buying the spread, and this trade makes the most money if stock prices expire above $44 per share. The break-even price is $43.56 per share, and in real terms, you'll pay $56 to enter the spread, and your maximum gain is $44 per spread. So that's it for this week's show. Hopefully you guys have been hanging in there. I've created a few shorter shows over the last few weeks, mostly because I've been on the road every weekend. In fact, it is well after midnight where I am. I'm recording this show in Los Angeles, in town for a wedding. So get to enjoy some nice Southern California weather. But that does mean that I am up late producing the show, because if I go to bed and I finish it in the morning, this show would get posted well after the time that I like to stick to in order to get you guys your content early on Saturday morning. So thank you for listening. You are the reason why I record this show. Thank you for the emails that I get as well. I enjoy hearing from you guys. Love the questions as well. So keep asking questions. Keep reaching out. You guys are amazing. Have a wonderful weekend. And as always, happy trading. Thank you for listening to the Weekly Option Podcast. Please subscribe to our show and visit us at www.theweeklyoption.com. Disclaimer: there is a very high degree of risk involved in trading. The indicators and strategies described in this podcast are for educational purposes only and should not be construed as investment advice. For our full disclaimer, visit our website at www.theweeklyoption.com.